Hello, everyone. James here with Certified Exit Planners, partnered with New Leaf Brokerage. Not sure why everyone's here, but perhaps you're looking to learn a little bit more about exit strategy, maybe business planning and strategic planning. Perhaps you want to understand how a sale works with a business, what drives value, how to value a business, or mitigate taxes, all of which can fall under the realm of this presentation. Feel free to contact us after the presentation, of course. We're here in Charlotte, North Carolina. However, we work all across the country helping business owners that are looking to either sell their business in less than 1 year, aka brokerage, or businesses that want to sell in 2 years, up to 10 years, and even longer in many cases, where they're essentially just trying to build value within their company. So, with that being said, I'll get started here. 100% of business owners will exit. That is absolutely true. Most business owners are going to sell to a third party, maybe transition to a family member, and unfortunately, some will close up shop and not understand that their business is worth something or could have been worth a lot more with a few tweaks and a little bit of strategic or exit planning. With that being said, we'll move on to the next slide here with Warren Buffett. I love this quote. When you start a business, you should start with the end in mind. Essentially, exit planning is business strategy. When you implement an exit plan, you're really de-risking the business, you're generally improving the value of the business, and you're increasing your options and demand for the business through the buyer lens. And so that's really what Warren Buffett is mentioning here. In my email tagline, I use operate with the end in mind, which is a similar nuanced approach, but I truly believe that it's the best way to operate a business, regardless of when you decide to exit, for you, your family, your employees, which is always top of mind with most business owners. So who are we and why it matters? Well, James here, as I mentioned, I'm a CEPA, Certified Exit Planning Advisor, a Value Builder accredited. Essentially, that's an exit planning software we use and utilize and leverage with our proven process. A business broker and a former small business owner, a current one, and operated, sold, and ran a few businesses. So sat on both sides of the table. We've closed over $90 million in deals, SMB, small to mid-size, uh, for some folks. Or another way to say it is maybe lower to middle market is a pretty common term within our circles of centers of influence or sphere of influence, as some people might say. And so, we have the tools in the team to get to the finish line. I focused on three folks here. That's myself, my wife in the middle there, and Phil. However, we have a much larger team to back us for whatever type of deal that we're operating with. And a lot of times we're working together and have different backgrounds or ran different types of businesses or specialties. So we're leveraging our experience there in many different ways. And kind of smack dab in the middle there is a little picture of me when I was operating a trade business there, a spray foam insulation company. It's maybe hard to see, but right there in the middle, that was a very interesting experience as well. And so do have exposure to franchise and franchise models as well. The next question I'd like to pose is, who's on your advisory team? Most business owners don't really consider it in that aspect, I would say. The majority of the folks I talk to are not really thinking it from an advisory team or a board of directors. But in reality, if you've started an LLC or an S Corp or a C Corp, et cetera, you're really supposed to have a board of directors or an advisory team to operate with meeting minutes, et cetera. A lot of people don't do it, especially if they're a solopreneur kind of thing. But the point of it is to establish an advisory team and have consistent check-ins with leadership and clear communication so that you're really moving toward that exit with confidence and clarity, and really want people to think about who should be on their team, family members and CPAs, attorneys, etc. We've listed a handful on this slide, and like to point out that generally each transaction has at least four individuals: a buyer, seller, and then an M&A attorney for both sides, unless you're choosing a transactional attorney that is representing more of the transaction. And then obviously, if you're represented by a broker, your bankers, your lenders, a lot of CPAs, accountants, maybe an investor team, a Q of E. There's a lot of third parties involved. And so if you wanted to go DIY, more power to you. I would just be very aware of of the amount of third parties, and you would want to appoint someone to quarterback that. And maybe that's a broker or an exit planner like myself, or maybe it's someone on your current advisory team, aka you, a family member, etc. But either way, it really needs to fall into someone who's capable and will be held accountable for such an important event, especially when, generally speaking, 80% of business owners' value is locked up into their business. The best way to really think about it is kind of if you have one singular stock or 80% of one stock, the analogy I like to use is what if you had 80% of your net worth tied up in Blockbuster? They kind of kept operating in the same manner, and Netflix completely wiped them off the map. That you're not diversified, just like a mutual fund. So the point is, may want to consider diversifying and de-risking your business because it is, in many cases, your most valuable asset, and that in conjunction with your house perhaps and some real estate, but just mitigating and treating it with quite a bit of attention and care is paramount. Are you prepared for that future exit? We like to focus on simple concepts because simple generally works. A lot of times it just requires time, effort, and a little bit of planning. And so we focus on the plan, prepare, profit, three P's, essentially being proactive versus reactive is what it boils down to. And the statistic on the right is 100% accurate. 4 out of 5 businesses will not sell due to lack of preparation. And so we're really trying to flip that script, so to speak. And so I'll repeat that 4 out of 5, 80% of businesses will not sell due to lack of preparation. And what that generally means is they're closing up shop. And, I'm extremely passionate about preventing that and increasing value and helping from an employee perspective and really putting together a cohesive plan that benefits the business owners, their family, and their employees. And that's really what we're trying to do. We're trying to transition them to other business owners with similar mindsets. A great example of that would be legacy business operating 10, 20, 30 years. Well, we want to find a buyer that's similar. We don't want them generally to go to a private equity firm and kind of get gobbled up like a lot of what's happening currently. So, we're really passionate about aligning the seller's values with the buyer's values. And that proves to be a very validating and rewarding process. So what you'll walk away with today is we're going to discuss, high level key drivers of business value, the buyer's lens, what are buyers looking for, a general roadmap for a future sale, how long does it take, a few different checkpoints, so to speak, some high level sale expectations, et cetera. What does a general sale look like? And, the risks of inactivity, meaning if you don't take action, what are you risking? And that's a very important one. The biggest thing that I can convey is to start the process. It doesn't have to be extremely fast paced. You might be exiting in 10 years. I totally understand that perspective. The biggest thing is starting the process and thinking about it from many different angles and being very careful on tax mitigation and how you want to structure a deal and what kind of buyer you want to work with and essentially going back to what I mentioned before and what's at the bottom of the screen here, exit planning equals business strategy. You're essentially operating your business with the end in mind. And so when you do that, you're increasing the value and you're de-risking your position and you're essentially creating a much better position for you, your family, and your employees. And that's really what we love doing. So I'll take a quick pause there. If you're a little bit overwhelmed, completely understandable. If this is a new concept to you, that you might feel that way. If it's you've been kind of rattling around and been reading about it, maybe not quite as much. But at this point, I'd like to encourage people to kind of think of it in a piecemeal, going back to that simplistic viewpoint. Just climb one limb at a time. I'm afraid of heights, but and so maybe I should have used a different analogy. But one step at a time, perhaps. But just focusing on a few high level goals and just building a roadmap is really what we're trying to do. And a lot of times those concepts and principles are fairly inexpensive. They just take time and effort. And so putting together a cohesive plan is very valuable. So, take a pause and just go one limb at a time, one step at a time, and build towards that goal. A lot of times we're working with wealth advisors and financial planners and ensuring that you close your wealth gap and you can retire with confidence that you're going to have enough money for you and your family and spend more time with them and travel with them or spend time with the kids or grandkids, etc. So that's one of the biggest things about us. We're not just looking at the transaction itself and the exit plan. We're looking at post sale. How can we really make your life fulfilling and help you with that plan as well? So we view ourselves as a complementary service to existing folks on your advisory team, not replacing anybody. And so we love working with other professionals. The blueprints, going back to some of my experience in the trades specifically, it always comes back to a house. I think of us as maybe an exit architect, so to speak. And so might as well look at a blueprint, right? So the first step is the foundation, assessments and valuation. So we conduct assessments and we look at the business valuation. What is your business worth currently? Regardless of where it's at today, we're just establishing that baseline with a range of value. What is it approximately worth? And, maybe we need to bridge the gap and build towards something, but at least we know where we are today and we can build for tomorrow. And so that's kind of the foundation notated here. The next step is building the frame of the house, 8 key drivers. Let's focus on the 8 key drivers of business value. A lot of businesses or strategists will categorize them a little bit differently, use different terms, but they all come back to the same basic 8 to 12, kind of drivers. And so we'll go over a couple of them today, a little bit later. But the point is that they're very simple in concept and maybe need to be considered from a different angle and think about things from a different light to maximize your value and de-risk your business at the same time. And so finally, our next part of that process is, a 12-step module. In certain cases, we're just basically prioritizing, from a SWOT analysis, opportunities for improvement. What is the most important and what will increase value the fastest? So that would be number one on our list. So we might jump down to a different module. It's not necessarily sequential. We want to prioritize based on adding value and really talking through that and see how it fits into your exit plan, whether it's 1 year, 2 years, 10 years, etc. 8 key drivers of business value. I'll go over a couple of them today. If you have additional questions, obviously feel free to contact us after. The number one is the big one, financial performance. Most buyers are going to focus on that initially for multiple reasons. Number one, if the numbers don't make sense, then there's no reason for them to proceed. So if the numbers don't work, they generally pass on the opportunity. Additionally, they are reviewing it from a lender's perspective. We do that as well, to proactively kind of set sellers up for success. But if a lender is not going to approve it and they're trying to utilize leverage, the SBA, AKA, that kind of thing, then we want to make sure that we're setting a reasonable valuation and make sure that we know what to expect and be proactive there. There's a lot that goes into that financial performance, and there's a lot of time that we spend there. I look at a lot of tax returns and I can tell a lot about a business from the data and the analytics side, but the other portion or side of the coin there is the human capital. This is a business. It's not just dollars and cents. And I never felt that way while operating a business. And so I'll jump down to number 8, hub and spoke. What's the structure of your business? Who's involved? Who are your key employees, et cetera? What hub and spoke, meaning, web of folks do you have from your structure? And the test there is, will your business operate without you for, let's say, when you're on vacation for a month, or maybe you needs to have surgery, for example. Perhaps those are some things that will impact you, and we'll go over that a little bit later. But the point is understanding how to increase transferable value through human capital, your processes, financial performance, and a lot of these key drivers is incredibly important. The other one that I'd love to go over is number 5, recurring revenue. That one has been a focal point of late, especially with the uncertainty from an economics perspective. The more predictable revenue, the more valuable your company is, generally speaking. I'll jump down to number 7 finally, and we can go over some of the other ones at a later date. But number 7, customer satisfaction. A lot of business owners really intuitively know that their customers are happy, but are they measuring it? And I'm not talking about Google reviews. There's an NPS survey, super simple, very effective, and it really tells you a lot more about how to drive additional sales. So it kind of folds in. All 8 of these work cohesively together. So when you increase your performance in one, it generally has synergy with another. And it compounds essentially your value. So it's not a 1-to-1 ratio. It generally is much more than that. And so that's why it's important to look at all of them, regardless of how well you think you're doing in each of them. Our proven process, coming back to what I mentioned, to reiterate: assessments, qualitative and quantitative, numbers and not numbers, basically. Valuation, establish a valuation. Where are you today? Range of value, your 8 key drivers that we just mentioned before, and then your 12-step module. So our proven process is going through those different segments. If you don't understand all of them at this time, no problem. That's something that we can discuss at a different time. However, the point is to take action, get evaluation, and possibly consider an assessment to establish where you are today, which will kind of lead into these charts here. The power of exit planning. We fully believe and understand and see the ROI every single day in securing value within your business. And what I mean by that is an example of a real company here, Avocado Inc. We redacted obviously the real company name here, but have a little fun with it. Avocados are obviously healthy and delicious, so kind of focused on that. Before the exit plan, 3.75 million in revenue, profit 285, not great profit efficiency, below 10%. Their sellability score, and that's kind of one of the assessments that I mentioned, 47, not great. No problem if your sellability score is quite low. The average is only a 53. It's very, very difficult to get above a 75 in reality. And so the idea is just improvement there and to reduce risk. So they're and the combination of the revenue, the profit, and sellability score are the biggest drivers on your industry multiple. And that's generally how evaluation is done from not only a buyer perspective, but a lender perspective, but also an internal review, and even some of the more complicated valuation methods like a discounted cash flow. So we won't get into that. It's very complicated. We like to keep it simple. So valuation here is just around 570K for this business. This was several years ago. And after a couple of years, revenue jumped to about 6 million through our proven process. Essentially, profit skyrocketed 1.1 million. Sellability score goes through the roof, which has a major impact, goes from a 2 multiple up to a 4.5. So their range of value now settles into, roughly that 4.5 to maybe 5.5 range. Conservatively, we're going to take the middle there in terms of expected sale price at about a 5.175 million. So massive value add there. And that's the power of an exit plan. That's really what we're doing. We're going through a simple process to increase the value and de-risk it. Exit planning equals business strategy is really what I'm getting at. And so that moves us over to Spuds LLC, another company, kind of sputtered out. That's how I came up with the name. But they weren't working with us, weren't really aware where to start. Paralysis, essentially. They didn't take any action. And 2 years ago, their revenues were solid. Nice little business there, 2 million. Profit was solid. Sellability score was decent. And they had a pretty good industry multiple. Most folks are going to fall under that 2 to 4 range. Most are around that 2.5 to 3 if they're under 5 million in revenue, roughly. Just keep that in mind if you're thinking about your own business. And so their valuation was around 1.1, and they essentially took their foot off the gas and didn't do a lot of things that maybe they should have. They didn't talk to their advisory team or didn't have one, and therefore their revenue started dropping, their profit decreased, their sellability score dropped. So all three of them degraded and basically reduced their industry multiple to a 2.5, and that might even be generous, honestly. And their valuation is below 400K. They lost their business is worth 1/3 of what it was only 2 years ago. And so that's what we really want to prevent. Our biggest goal is to prevent that and make sure that we can at least stabilize the business and possibly improve it. And so when you do decide to sell, then you're working with your advisory team and implementing that retirement plan that fits for you. So extremely important to think of that and understand that a lot of your value in your business is tied to your personal net worth, or some people call it the personal balance sheet, so to speak, if you've heard that from maybe your financial advisor. With that being said, we'll move on to the next slide. What can derail your business overnight? I've mentioned de-risking a few times and improving value, of course. Well, the 5 Ds, 50% of business owners will experience one of the 5 Ds. I'm going to repeat that. 50% of business owners will experience one of the 5 Ds. And if you were operating around COVID, it's probably even higher, closer to 100%, because number 5, distress, is in reference to basically instability in the economy. And then, recently with the economy and the market kind of being less stable, you're going to have stressors with a lot of businesses. Some industries not so much, but others will. So might want to think about how that may impact your business in the future. And an important point here is to de-risk your business. How can we mitigate these 5 Ds? Because they tend to happen when you when you least expect it or aren't sure when they're going to happen. And so we're going to skip through death, disability, and divorce. They're pretty straightforward and very unfortunate, obviously. But number four, disagreement. I receive about a call a week about business owners, generally two partners, 50-50 owners, don't have an operating agreement. And now they're spending thousands of dollars with attorneys trying to resolve the issue. Generally speaking, it ends very poorly for both, oftentimes even worse for one individual, and usually the person that just wants to get out of the situation. And usually they'll receive between 10 and 20% of what they really deserve. And so I'll repeat that. It's usually around 10 to 20, maybe 30%. And a lot of times those funds that they might receive for that resolution just go straight to the attorney. So it's very unfortunate. It's one of those things where we really want to prevent that. And so we work with specific M&A attorneys to get ahead of that and essentially implement a plan when things are operating well. So when people are in a good mood. And so when things go awry, you have something to point back to. We discussed this, this happened. We're now going to address it, and we have a general plan here. So that's the concept behind that, and something that a lot of business owners forget to implement. Finally, you don't want your business to go into probate. So I was talking to an M&A attorney recently about this exact topic. If you're a solo entrepreneur or you know, single owner LLC, S corp, etc., if you don't have an operating agreement and you unfortunately pass away, your wife, spouse, etc., husband, etc., they cannot access some of that cash to some degree because there is no operating agreement dictating that they have control. So one of those things where we really like to help people think about how to mitigate risk on the front end for you, your family, etc. Exit timer. This is a fun one. I love this slide. I liken it to cooking a turkey. Or are you prepared for your exit timer to go off? If not, the turkey's getting torched. Meaning, if you don't know when the timer is going to go off, then your business, aka the turkey, is going to be overcooked or undercooked. You know, that you want that nice juicy turkey. And so the point is to kind of think about your exit timer. What's your ideal timer? And it'll adapt along the way and change, but generally speaking, it takes longer than you think. So, you know, focusing on phase one, your exit plan, that can range from 1 to 10 years, even longer. But, you know, phase two is the part that I think folks really need to focus on, in phase three. So 6 months to 1 year to sell a business, assuming they're organized. And so it can take even longer in some cases. And so if you have an exit plan, you're much less likely to have a longer sale phase because you're prepared, it's clean, and the buyers know it and can feel it. And so phase three, generally a post-close transition, lasts between 1 and 6 months. The buyers are going to ask the seller to stay on for a little bit of a training session. It's not like selling a house where, you know, you just hand them the keys and that's it. A business has a lot more operating parts, and the more you have in that hub and spoke number 8 on the 8 key drivers in terms of delegation and structure, the less time you can spend during that transition generally. And so there's a lot of value there, you know, the transferable value. And the perks of planning at the bottom there, 70% higher sale price, less time in the market, improved transition. So folks that prepare really see the benefit from the dollars and cents perspective, but also the ease, you know, the stress levels and really not taking over their life. And so the other advantage of being represented by a professional, whether it's a broker or an M&A attorney who generally don't have time, but they can help with that as well. You know, or a CIPA like myself, you know, just work with somebody is usually going to make sense unless you have a dedicated person that can kind of focus from an accountability perspective and drive the whole project and keep things organized and, you know, from that point forward. So, and, you know, we're not encouraging folks to sell the business now, and we're not encouraging them to sell to a third party necessarily. You know, we just had a conversation with a business owner last week with, they're going to sell it to their employees an ESOP. So if you want to learn more about what an ESOP is, then feel free to contact us later. The point is that, you know, they're selling to an internal team, their management team. So kind of cool situation, legacy business. Just a complete home run. So those are some of the things that we help folks with, and think about their options. There's a lot of sale options. It's not just sell to a third party or transition to a family member. So that brings us to the fork in the road. Yogi Berra, one of my favorite baseball players. You know, the fork in the road, you should take it. And what I mean by that is, you know, you're at a decision point. You can, you know, perhaps do nothing, hope for the best, and go from there. You know, a lot of times that works out. A lot of times it does not. However, my viewpoint on that is to encourage at least thinking about the process and maybe taking some action and, putting some feelers out and talk to certain people and, leverage your existing advisory board or team if you have one. If you don't, we're happy to help. We have a very strong network of folks, so we can bring people on the team. A lot of times we're doing consultations or high level views to start with, and then when appropriate, we're helping people bring in other professionals to essentially reduce costs. So, our goal is to not have a massive advisory team right out of the gate. We're moving specific specialists in and out of the process when appropriate to keep costs down for business owners while maximizing their value and their transition plan. So, with that being said, I would encourage people to start preparing now, maximize your value through the plan, prepare, profit, be proactive, not reactive. And I think you'll be very happy with results. So with that being said, next steps, if you did want to, you're more of a verbal person, one-on-one meeting, option one, QR code on the left there. Would love to talk to you one-on-one and kind of strategize. We can talk about where you are today, get to know each other a little bit. Option two, if you really want to look at more of that sellability score and take the sellability assessment and then kind of see what you see there and kind of discuss the results and maybe do a verbal one-on-one later, then option two there. Either way, take that next step and see, get some more information for yourself to make the best decision for you, your family, and your business. And I guess with that being said, I just want to say thank you for being here. Again, my name is James. My wife Liz there is on the screen as well, and then our third member, Philip. And we're really helping on the exit planning side. Just to reiterate, we have we're also working day to day as brokers with New Leaf Brokerage. So I'm specifically about spending about half my time on the exit planning side, about half my time on the brokerage side. Liz and Phil are integral parts of our team and have very complementary and diversified skill sets and very different perspectives. And so we're really trying to bring hospitality and ease and clarity to business owners. And so whatever facet you need help with, whether that's selling in less than 12 months, aka brokerage, or maybe you want to plan 2 to 10 years down the road, certified exit planners, we're here to help, and feel free to email or call us anytime. So with that being said, thank you for being here, and we're happy to help and connect virtually, or if you happen to be in the Charlotte market, we can absolutely meet up as well. So thank you for your time.